There's a financial system larger than the stock market, moving trillions of dollars, and most people have never heard of it. It doesn't have a trading app. It doesn't show up in your portfolio. And when things go wrong, it doesn't fail slowly. It breaks fast. This is the shadow banking system. Right now, while headlines focus on stocks, interest rates, and inflation, a parallel system is quietly doing the heavy lifting behind the scenes. Moving money, creating credit, financing the global economy. And in some ways, it's even bigger than traditional banking. But here's the catch. It doesn't operate like a normal bank. To understand why that matters, you have to understand what a normal bank actually does. You deposit money. The bank lends it out. It keeps a buffer. It follows rules. It has a safety net, regulation, capital requirements. If something goes wrong, there are mechanisms to slow the damage. Now remove most of that. Same basic function. Moving money, creating credit, but without the same level of oversight, without the same safety nets. That's shadow banking. It's not one thing, it's a network. Money market funds, hedge funds, investment vehicles, repo markets, entities that act like banks but aren't treated like banks. Here's how the system actually works. Imagine large institutions with excess cash. They don't want it sitting idle, so they lend it out, short term, often overnight. This happens in something called the repo market. One side provides cash, the other provides collateral, usually government bonds. It looks safe, efficient. Cash flows in, collateral flows out, then reverses the next day, over and over again. This creates liquidity, a constant flow of short-term funding, which fuels everything else. Trading, investment, leverage. And this is where it gets interesting, because that same collateral can be reused. One bond, used in multiple transactions, pledged, repledged, recycled through the system. So the same piece of collateral supports layers of activity. This is called rehypothecation, and it quietly multiplies the system size. More credit, more liquidity, more activity. But also, because now everything depends on confidence. As long as everyone trusts the collateral, the system works. Money flows, deals close, markets stay liquid. But if that confidence cracks, the chain reaction begins. Lenders pull back. They want their cash. Borrowers scramble. They need to replace funding. Collateral gets questioned. Values get reassessed. And suddenly, that smooth, invisible system starts freezing. This isn't theoretical. In 2008, parts of the shadow banking system collapsed faster than traditional banks. Not because the system was small, but because it was so interconnected and lightly protected. Short-term funding disappeared, liquidity dried up, and the ripple effect spread across the entire global economy. Now fast forward to today. The system is still here. Larger, more complex, more integrated, but still dependent on the same core idea: trust. Publicly, we talk about banks as the center of finance, deposits, loans, interest rates. But underneath, a significant portion of global credit flows through a system most people never see. A system that can expand quickly and contract even faster. And here's the uncomfortable part. Because it operates outside traditional banking rules, it can take on risks that regulated banks can't. Higher leverage, shorter funding cycles, more reliance on continuous rollover, which works until it doesn't. There's no simple safety net. No guaranteed backstop. Only intervention after the stress becomes visible. So, you end up with a system that is essential, but not fully controlled. Supporting markets during good times and amplifying stress during bad times. Now, zoom out. Why does this system exist at all? Because demand for credit never stops, and traditional banks have limits. Regulation, capital constraints, risk controls. Shadow banking fills the gap. It provides flexibility, speed, scale. But that flexibility comes with trade-offs. Less transparency, less protection. More reliance on confidence. So while it helps the system grow, it also introduces new points of failure. Quiet ones. The kind you don't notice until they matter. And today, much of global finance depends on it functioning smoothly. Every day, without interruption, without doubt. Because the moment that doubt appears, the system doesn't just slow down, it can seize up. And when a system this large pauses, everything connected to it feels the impact. Which brings us back to the uncomfortable reality. There's a market larger than stocks, running in the background, powering liquidity, shaping risk, operating on trust. And most of the time, you never see it, until it becomes the only thing anyone is talking about. So the question isn't whether shadow banking matters.